I'm Charlotte McLeod with the Investing News Network, and here today with me is Rule of Sprott. Thanks so much for being here today.
Pleasure to be with you, Charlotte. Thank you.
Yes, and we're here today at Minds and Money London. You've been speaking quite a bit about financing here. You mentioned yesterday in a panel that Sprott will be looking more at exploration financing moving forward. I wondered to start off if you could give me a sense of whether that's really a big change for you. What would that look like from what you're doing currently?
I'm not sure it's necessarily a change for Sprott, but I think Sprott is unusual among large institutional investors to have a willingness to finance microcap companies and finance exploration. Certainly there's exploration capital available for places like Northwest BC or Northern Ontario, but being willing to finance generative exploration in other parts of the world I think is unusual. And Sprott would like to aggressively fill that capital void, as we did, sort of 2000, 2001, 2002, to good effect for us.
This is coming at a time when we are, I think in theory at least, seeing some major mining companies step up interest in exploration. Would you say that's the case?
That's a great observation, Charlotte. It's true. The major mining companies have, I think, both underinvested and misinvested in exploration for 20 years. And I think the major mining companies themselves have begun addressing that imbalance. Certainly, the exploration results enjoyed by Rio Tinto in various jurisdictions shows that the majors still have a place in mining. From your audience's perspective, I think what's interesting is that the exploration spending by majors joint venturing with juniors will increase dramatically, and the participation in junior equity markets financings done by majors will also increase, I think, dramatically.
So for yourself, I imagine when you are putting money into these exploration companies, you would be wanting to see them make a discovery. So what would be some signs that a company could be, very early stage signs that a company could be on track for a discovery?
The first sign is people. You have some people who have been serially successful, either in exploration or corporate management, or more rarely both. I think it's critical to align yourself with the best people at any part of the value creation chain. But certainly people's track record in discovery does not align conformably. You have people like Robert Friedland, who over 40 years have been part of discovering 5 Tier 1 mines, while most people haven't found any. So in the beginning of the exercise, it's people, people, and people.
Okay, so speaking of Robert Friedland, you mentioned yesterday that his method for exploration success is conducting very extensive exploration over one area over a period of time. You also, though, like prospect generators, which you talk about sometimes, which kind of do the opposite. They do a little bit on a lot of different spaces. So how do those two contrasting approaches produce good results?
They're more similar than you think, in that an effective prospect generator has technical expertise, but also often socio-political expertise in one particular region. Robert understands that it takes a decade to make a discovery. Good prospect generators also focus on regions where they have definitive competitive advantages. The difference is that prospect generators use other people's money. Friedland uses his track record and his amazing sales skills to have a lower cost of capital than most of his competitors. What's similar is that the good prospect generators understand that district scale exploration can take a decade. Robert understands that too. Most people who speculate in junior mining companies have trauma holding stock over a long weekend, and most junior miners at least pretend that they're going to deliver results in 90 days, which is an unrealistic and frankly stupid expectation.
Okay, very interesting, because on the surface they don't really look similar at all. So I think usually when you're asked about is there money available for companies, the answer is yes for particular companies. But it's not only good companies that are getting money. So I wondered if you could talk a little bit about good and bad financing deals and terms, and what should investors be looking for?
When a market is hot, investors are really stupid. They just throw money at transactions. And if you throw money around, people will in fact take it. The investment banks will take it because they don't care about the outcome. They just want the fee in a hot market. Management teams will take it because they have to sustain their salaries. In bad markets, the ability of bad management teams goes away. Ironically, bad markets are the lowest risk investment climates because the people who are left are high quality people and you don't battle other investors for access to them. So my suspicion is that the positions that we've taken for the last 2 or 3 years, we invest for the very long term, will end up being extraordinary investments. And my suspicion is in 2023, 2024, I'll be kicking myself for not being more aggressive in 2017 and 2018.
Okay, so normally around the end of the year, we would be asking you about what's coming up next in the coming year. But we're at the end of a decade now, so I want to have some fun questions about the past and the future. So first question, as we're coming up on the end of a decade, what would you say has been your best call the last 10 years?
Best call for the last 10 years? Well, I guess my successes for the last 10 years have evolved around decisions that we made in 2009, 2010 to emphasize lending rather than equity investments. That isn't to say that we didn't invest in equity, but we built a very large lending business in Sprott, the largest non-investment grade lender in the space. And at the same time that the TSXV Resource Index lost 88% in nominal terms, we generated plus 15% annualized internal rates of return at Sprott. 15% is a good headline return, but if you compare that headline return to the losses suffered by equity investors, the delta between our gains and their losses were truly extraordinary. So I would say that the best thing that we did as an organization, and I was certainly part of that, was emphasizing lending at the expense of equity. I think very recently, and again I'm speaking for Sprott rather than myself, with most money managers like ourselves de-emphasizing natural resources, we decided to go all in. We sold our generalist mutual fund business, we increased our staffing in resources, and very recently entered into an agreement to buy the Tocqueville group of mutual funds. People are moving away from active management, so we're moving back into it, and people are moving away from resources, so we're re-emphasizing resources. Those are contrarian strategies, which have, frankly been the hallmark of my career for 40 years. Sort of more of the same. It's just that maybe the transactions are a little different than they used to be.
Sure, and if we do best, we have to do worst as well, if you don't mind.
Boy, the legacy of bad decisions in the last 10 years is very strong. I would say that the most egregious mistake I made, looking back, in 2010, I had a lot of capital to deploy, and I couldn't find places to deploy it to. If you can't find stuff to buy, if the market's that expensive, you need to sell. And I did sell. I sold probably 30% of my portfolio. Why didn't I sell 80? Why didn't I sell 90? The truth is, a market is a market. And something that you own is, if you're not willing to buy more, something that you should sell. And so the stuff that I didn't sell, I suffered the same 50 or 60% decline on that everybody else suffered through. So I would say that my most egregious mistake was probably when I recognized the market to be overvalued in 2010, not being a more aggressive seller. I made up for that a little bit in the mini melt-up that we had in 2016. I came to see that, as an example, the small uranium stocks tripling in the first 3 months of 2016 was a temporary rather than a permanent circumstance, and I managed to do some selling then. But I would say my big mistake was not being an aggressive enough seller when the market was so hopelessly overvalued in 2010.
Okay, so looking forward at the next coming decade, can we choose a metal of the decade?
You don't get decades in metals, sadly. You don't. I think next year, I think it's a reasonably intelligent bet to emphasize gold. I think the wind is in gold sails as a consequence of, first of all, the fact that it's still not a popular metal outside of traditional gold investors, but also because of quantitative easing, which if you and I did it would be called counterfeiting. And the fact that the world's risk-off trade seems to be negative yielding bonds. And the whole concept of a bond that has no yield is a very foreign concept to me. So my suspicion is that when we have a period where gold does well against weak currencies and does okay against the dollar, usually in my experience that's presaged a point where there was a lack of confidence overall and gold did extremely well. And my suspicion is, in this case past is prologue, that we're rerunning the earlier part of last decade, and I would expect that gold does well. If gold does well, silver will recover later. And the sort of penultimate move in precious metals will, of course, be the high-quality silver equities, which are scarce. Moving beyond that, because everybody else is moving away from energy, I'm personally, with my own money, going to make a strong move into Calgary this year. This reminds me of nothing so much as 1990. And when I look back, my aggressive moves in Calgary in 90 and 91 paid great dividends for me later in the decade. So I certainly will be involved in conventional energy debt, and conventional energy equity, more in Canada than the United States, because the sector is more depressed. Looking further out, there are metals that are essential for the way we live. I'm thinking uranium, so that the lights go on, as an example. Copper, so that electricity can be generated. In the near term, I'm not bullish about those metals, because I believe after 9 years of recovery, this recovery is fairly long of tooth. I'm not an economist, I'm just nervous. And I believe that if you had a slowdown in the economy, that demand for industrial materials would falter. But looking in the longer term, 4 to 5 years, the prices offered up in commodities markets are not sufficient to incent enough production to maintain the supply of commodities that we need to sustain our way of living. And in my life, when commodities that are necessary to sustain our way of living are underpriced and the industries are in liquidation, that sets the stage for really, truly spectacular recoveries. Your audience, of course, will want to know when, and I have no answer.
Okay, well, I think that probably comes as close as we're going to get to a decade in the future outlook, so we can leave it there. That was great. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rule of Sprott.